Okay, we're going to go ahead and get started. First and foremost, thank you all for taking time out of your day to join us, and we hope that you find this webinar insightful. Just a few housekeeping notes. If you have any questions or comments throughout the presentation, you may submit them through the control panel under the questions field. In addition, for those who require CE credit, it's important to be logged on for the duration of the webinar to receive the credit. And while everyone will receive a follow-up email with the recording and presentation within the next couple of days, you will receive your CE certification and details separately in about a week or two. So without further ado, I would like to introduce our key presenter, Eric Magyar of Janus Henderson Investors, as he leads us through prudent practices. But first, Chris Garrison, Senior Consultant with Plan Pilot, will share a few insights and observations. Chris?
Great. Thank you very much, Placilda. And again, welcome everyone to today's webinar. We're very pleased to have Eric join us today, an industry veteran who's got some very helpful and relevant information to share with you. An important aspect of how we at Plan Pilot work with clients is to bring valuable information as well as thought leadership. And in today's session, Eric is going to accomplish a couple things in one presentation. He's going to give you some very helpful and specific information about the fiduciary process, but he's also going to put it in very plain English terms, which I think you'll find exceedingly helpful. At Plan Pilot, we believe that better outcomes and less risk are the key thoughts for a fiduciary process. And in today's session, Eric is going to take you through a couple of things, clarifying what the role of a fiduciary is, talking about what plan sponsors should consider when they think about their service providers. He's also going to touch on a very timely and important topic of conflicts of interest, something that is worth looking at more closely. And finally, as I mentioned, a very practical view. He's going to talk about some of the practices that plan sponsors should be considering. Eric, thank you for joining us today. I'm going to turn it over to you, and at different points in time, I'll weigh in with some of the thoughts that we at Plan Pilot would like to share. Thank you.
That sounds great, Chris. Thank you, everybody, for attending today. We appreciate you taking the time out to learn about your responsibilities as a plan fiduciary. And before we get into that, I would like to start kind of with the history. There once was a time before ERISA, the Employee Retirement Income Security Act, or ERISA. That was prior to 1974. Employers could revoke promised retirement funds for basically any reason that they wanted. And due to one pension fund collapse back in 1963, that really sparked the regulations we have today. And I think it's important to review history to see why these rules exist, why they're so strict. And that case, that plan was an automobile manufacturer, and they were in Northwest Indiana. They do not make cars anymore. That company, if you didn't think about it already, it's Studebaker-Packard. So the Studebaker-Packard Corporation was founded in 1852 in South Bend, Indiana. And for Studebaker, their problems were not based on automotive quality, but really financial management. And the problems came to a head in 1963 when their failure to basically reach epic proportion without the requirements for companies to disclose their finances. Studebaker employees had no way of anticipating the closure of the South Bend, Indiana plant in 1963. As if that weren't bad enough, Studebaker also slashed or denied entirely the pensions for roughly 4,000 workers. And there was really no ramifications against that company. So that was really the motivating case or incident that happened, that it took about a decade to put the regulations into place. So in 1974, President Ford signed ERISA into law, protecting employee retirement funds for the first time in American history. To this day, ERISA requires employers and plan sponsors to be financially transparent, adhere to a strict code of conduct, and report to the Department of Labor each and every year. So that's the background. And we're going to talk a lot about fiduciary, what's a fiduciary, the responsibilities, and so on. So here's all the questions that we'll cover today. And as in plain English, as Chris said, what is a fiduciary? Who's a fiduciary? What are the different types of plan advisors, their business models? So you can reflect on who you work with, if you work with a consultant or advisor at all to help you with your plan. How can I better identify potential conflicts of interest? What are conflicts of interest? There's a couple court cases we can highlight to really show that have been tested in the courts. What are some additional questions I should ask my provider? And it's really key to be armed with the right question as well. Knowing the right question is crucial. And what are some prudent practices and processes that you can all put into place today or this quarter to help you become a better fiduciary and have a well-managed plan? All right, so what is a fiduciary? And I saw a recent study, 43% of fiduciaries surveyed were unaware that they were even a fiduciary in the first place. And so here's the definition. A fiduciary is a person or organization who has the highest legal duty owed to another party and is bound ethically to act in another party's best interest. So unlike that Studebaker case, they could slash the benefits, deny it for any reason. ERISA really put trust and ethical standards at the top of the priority, really mandating that if you are a plan sponsor and host a retirement plan, you are held to the highest legal duty in the land. So that's a responsibility. It's a very high level. So what are the duties of a fiduciary? And since I said, they have the highest legal duty, per the DOL website, if you were to take a look at dol.gov, the primary responsibility of fiduciaries is to run the plan solely in the interests of participants and beneficiaries, and for the exclusive purpose of providing benefits and paying plan expenses. Fiduciaries must act prudently and must diversify the plan's investments in order to minimize risk of large losses. In addition, they must follow the terms of plan documents and avoid conflicts of interest. And we'll get into all of that in greater detail throughout this presentation. But so there's a lot. There's a lot at stake on the responsibilities of fiduciaries. You can also hire plan consultants to share in that responsibility and all these duties. I know that a lot of companies today are very challenged with COVID-19, stay-at-home order, that if you are running a business, the retirement plan might be the 11th thing to do on your top 10 list to do, keep the business afloat. And so it really is a lot of value to hire somebody to share in all of these duties for you and with you. They can't take it away from you, but they can share in that responsibility with you to make sure everything is done properly. As I said, you're held to the highest legal standard. There are civil penalties for fiduciary breach in ERISA, and you might be familiar with some of those class action lawsuits out there. ABB, for example, was one of the first ones to kick it off, and they were found innocent. Now they had to settle for various violations, in particular, not following the investment policy statement. So there's not a lot of malicious intent behind these, but basically, if you don't follow the rules set forth by ERISA, if you don't know all the rules, ignorance is no excuse for not following the law. Also, your own investment policy statement. Have you addressed underperforming funds, put them on watch lists, followed the process you set forth? And if any of those are in violation, then there could be civil penalties involved. And here's the penalties on the screen. Basically not to exceed $1,000 per day. So it's very serious. We've seen the 403B industry in these lawsuits as well recently as a part of these civil penalties. And one interesting case, the NYU, New York University, for the first time in a lot of these cases that I've read, actually the judge asked 2 of the plan committee members to be removed as fiduciary from the investment committee because they lacked knowledge. They lacked a certain amount of understanding of their responsibilities as a fiduciary. So they were asked to be removed from that committee. And if you do sit on the investment committee at your plan, really be aware of what your responsibilities are, understand what's being discussed in those committee meetings, if you do work with a consultant or advisor, they can never take that responsibility away from you. You always have that, and I think that's very important. Chris, did you want to add anything on this, or should I just keep moving?
No, that's great. I'm glad for the opportunity to weigh in. Very daunting sort of standard that ERISA sets. It's very high and appropriately so to protect workers and their retirement plans. But what mitigates that a little bit is it's a very much a process-driven responsibility. And you do, as a plan sponsor, as a fiduciary, have to act as a prudent expert would, but you're not required to be pick the best funds to get to the absolute lowest cost. It's really about making sure that the retirement committee's process and the roles and responsibilities are laid out so that one time period to the next, you've established what your priorities and to-dos are, and you really are executing against them as someone who's responsible to someone else would do. And of course, Eric, I'm sure you're going to talk about the need for some of these things to be in writing, but while the standard is very high, it's very much a process-driven function.
That's exactly right. Great points. And to that end, here at my firm, we have a full presentation called Recent Case Studies of Fiduciary Failures, Why Plan Sponsors Are Being Sued, and the Importance of Process. Just like Chris said, it doesn't have to be the best performer. It doesn't have to be the cheapest fund out there. But you have to have a written process. You need to follow it, and you need to document. And in time after time, in all these court cases that I've read, if the plans followed a process and they documented it, they were fine. And the court case was dismissed. So they didn't have to worry about that. But that's exactly right. So ERISA doesn't dictate how you should invest the money, what you should invest in. They look to the investment policy statement. And if you have one, because you're not legally required to actually have it, but it is a best practice. And if you get audited, that's one of the first things the auditor will ask for is your investment policy statement. So you need to read it, you need to follow it, and then document that process. That's exactly right. Thank you. Now, a step up in the notch of criminal penalties on fiduciary breach. And back to my initial example, if you were to take a closer look at the Studebaker-Packard plan, they actually invested part of the pension plan that they had into a real estate deal that went bankrupt. And so, maybe they were benefiting from this in some way, shape, or form. But, if there is anything like embezzlement that has been taking place in the plan, that's basically criminal punishments. And as a fiduciary, obviously, you need to put the clients, the employees' benefit ahead of your own. And so, these are basically strict violations against ERISA and crimes, basically. So that these are some penalties there. So, who is a fiduciary? So that question comes up a lot. And am I a fiduciary? What are basically the legal tests of who's a fiduciary? And that's any person or parties who performs one of the following. They exercise any discretionary authority or control over a plan's management or administration, exercises any authority or control over management or disposition of plan assets, renders investment advice for a fee. That would be the consultant, perhaps, or advisor, at other compensation with respect to plan funds or property. So as far as you're concerned as a plan sponsor, do you have any discretionary authority of hiring and firing the record keeper, or exercising authority over any of the investments? Do you sit on the investment committee and make any decisions there? As I said in the NYU case, everyone who sat on the plan's investment committee have that fiduciary responsibility. So these are basically the tests that can come into play, and you can think about your roles and responsibilities in your plan to see if you fall in any of these definitions. Now, as I said, since ERISA was enacted in 1975, the advice has a 5-part test. So this would be basically who you work with as a plan advisor or consultant, and they would be a fiduciary if they fall under all 5 of these tests. So the person makes recommendations on a regular basis. So they can't just make a one-time recommendation. They're not considered a fiduciary. They need to do it consistently, pursuant to a mutual agreement or understanding. So you both agree that they're taking the fiduciary responsibility. Advice would serve as the primary basis of investment decisions. So no other readings or periodicals or other person's advice. They would be the primary and sole authority, basically, that you'd follow. And the advice is individualized based on the particular needs of the plan or plan participant. So if you have maybe the record keeper's educator that comes out to do education meetings, those are general in nature, typically broad best practices from people in different categories, maybe 10 years out from retirement, 20 years out retirement. It's not individualized. So those educators are not considered fiduciaries. So it's very difficult, as you're probably thinking, that someone would qualify for all of these tests. If any one of these 5 fail, that person that you're working with is not considered a fiduciary unless that's part of their business model. We'll cover that later if they do indeed act as a 321 or 338 fiduciary, and we'll explain that later. We'll keep the jargon out of that. So what parties are fiduciaries? So here on the screen, plan administrators, plan trustees, investment managers, advisors, named fiduciaries, deemed fiduciaries, and this last one where someone is a functional fiduciary based on what they do within the plan. So a lot of HR professionals that I work with, I've spoken at many SHRM conferences, statewide SHRM here in Illinois, Oklahoma, and Missouri. And depending on what you do on the plan, you could be a functional fiduciary, even though you're not a named fiduciary. So based on what you do for the plan, you might be a fiduciary, you might not even know it. So that's why 43% in that last survey that I've read, people don't even know they're a fiduciary, even if they are. And then, Chris, do you want to highlight anything here? Should I move on? I mean, there's a lot to take in here.
No, this is a good point to weigh in a little bit. Eric talked a little bit about people who are perhaps just not aware that they have a fiduciary responsibility. Coming back to one of the overarching themes is it's always helpful to put things in writing. And in this regard, if a plan does not have fiduciaries named in their plan document or some other document, then anyone can allege that someone who's in a position of responsibility relative to the plan could be deemed a fiduciary. So it's important to, once you've established your fiduciary process, your retirement committee, to capture in writing who those people are. And then, at a very practical note, and I know we'll talk about this a little bit later, anyone who handles plan assets, and the best example that we could come up with is someone who is responsible for making sure the contributions, are sent to the record keeper. They are a fiduciary as well. And they should be protected by the documents in the process that the committee puts in place to make sure that, just by virtue of doing their day job, doing the things that they need to do to operate the plan, they are covered by things like insurance and good operational procedures.
Great. Thank you, Chris. So what parties are not fiduciaries? And that's not to say these parties cannot act as a fiduciary, but in general, unless it specifically says that these parties are acting in a fiduciary capacity somewhere, they're not fiduciaries. So a broker-dealer and their registered representative. So that's a term, unlike financial advisor, who is held to a different standard than a registered representative. So it could get very confusing depending on the language. So if you work with a particular broker-dealer that out there, think kind of like an old one of the original stockbroker firms that you might have purchased a stock from. And their registered representatives, if it says that on their business card, they're not fiduciary unless otherwise stated. Record keepers, third-party administrators, a TPA, unless they act in a 316 capacity, which is another kind of lingo, but basically that means that they can act in a fiduciary. If you see those numbers, 316, 3 and then 16 in parentheses, they are not a fiduciary unless you see that. Actuaries, accountants, people who perform ministerial acts as part of the plan. So basically taking orders and so on. So, but be careful on those acts. As Chris said, some of those acts can fall into the fiduciary responsibility. So very confusing, very, very quickly.
And Eric, I think one of the easiest ways to find out for certain whether or not one of these parties, one of these providers is a fiduciary or has that responsibility is simply to ask them. And so what oftentimes is the case is firms who are in the record keeping and are a retirement provider, if they're in that business, sometimes it's plan sponsors believe or think that they are in fact, they have that fiduciary responsibility. If you ask, they may very well clarify things by saying they're not. That doesn't mean that doesn't mean something negative. It just means that that's not what they do. That's not part of their specific role to the plan. They can provide excellent services. You can have excellent relationships. What it really comes down to is they, by their function, are not specifically a fiduciary.
Yeah, that's true. It's not necessarily good or bad. And I think one of the best things about this presentation is if you can pull out a couple questions to ask your service providers, your advisor on your plan, I think that'll be time well spent, the 50 minutes that you've gone through there. If you have a couple good questions on what to ask so you're more informed. And typically, if they do act as a fiduciary, there is an additional service, potentially a fee for that responsibility as well. And Chris made a great point. If you're unsure, ask. And I think that's a great best practice. And so into, what about your plan advisor that you work with? So basically there's registered representatives, as I said, so we'll go into the definition of that, and then investment advisors. So registered representatives are governed by the Securities and Exchange Act of 1934, and they are required to deal fairly with clients, make suitable recommendations based on risk tolerance, time horizon, and other factors, and also disclose certain actions that are not made solely in the interests of clients. So these are basically called suitability standards that they have to. They can profit as a registered rep. They can earn commissions as part of, say, a trade, trading Amazon stock, for instance. And so they can collect a fee, or they could collect a commission based on that stock trade. Conversely, and just a different set of rules, investment advisors are fiduciary advisors. They're governed by the Investment Advisors Act of 1940 and ERISA, so two governing bodies. These acts require advisors to owe a duty of loyalty to plan participants and beneficiaries, make recommendations in the best interest of clients, and do the best that they can to avoid conflicts of interest altogether. So you'll see a lot of fee-for-service arrangements with the investment advisor that acts as a fiduciary to really avoid those conflicts of interest in particular. Now, Chris, I know that you at Plan Pilot can potentially act as a fiduciary as an RIA as well. Were there any other highlights you wanted to share? Because this can get confusing really quickly on this terminology of acting as a registered representative or acting as a fiduciary advisor. There's just two different business models. It's good to be aware of each.
Right. And on that point, I'd come back to something you touched on that's worth reiterating. Plan sponsors are always going to retain a certain level of fiduciary responsibility. You can't get rid of it, but you can delegate it, or you can hire experts to help you manage it. And you can even have people who aren't fiduciaries providing service to your plan. It's really about making sure you've got your proverbial arms around the situation. So plan sponsors, I think we're going to talk about it a little bit. Plan sponsors can hire a registered investment advisor, someone who's independent and will become a fiduciary, take on that fiduciary responsibility to do one of two basic things. One is pick funds for the plan sponsor to ultimately decide upon. So you might get recommendations across a couple different asset classes, and ultimately the retirement committee says we are going to pick Fund B over Fund X. That's typically known as a 321, an ERISA 321 consultant. Ultimately, the decision making at the fund level remains with the plan sponsor. A different model, sort of, is to provide, or to hire someone who has the discretion, an ERISA 338 consultant. They have the discretion to pick the funds that at face value may feel like you're reducing your workload or your responsibility. You're really just changing it. You as a plan sponsor would have to make sure you're monitoring the firm and their process and making sure that they are delivering to you everything they've been hired to do. So 2 different models. I know we're going to get into them. The key points are the fiduciary process invariably means the plan sponsor will retain some responsibilities, and B, the management process is where you can get into the different models that make sense for you, and also how to monitor the service providers who do not have that fiduciary standard to meet.
That's exactly right. And really your responsibility as a plan sponsor is to understand that fee structure, whatever it may be. You know, what the fee structure is, how much the fees are, who's getting paid what for what services, and so on. So we'll dive into some different types of advisor business models, depending on if you work with a registered representative or a financial advisor, so you can get a better understanding of how they work, and then maybe some additional questions to ask them to clarify some things as well. So 2 distinct business models. An advisor acts in a commission capacity. So the advisor is providing information, not advice, to the plan sponsor, to you. The advisor is compensated through 12B1 fees, and amounts may vary depending on the investments. And a little background on that. That's called revenue sharing. It's a legal, legitimate practice. It was brought up in the landmark case of ABB. And back in the 70s, 80s, 90s, when a lot or all of these 401k plans, 403Bs kind of predate that, but when these were startup plans, there was no assets in there. So to take the burden off of the plan sponsor to pay out of pocket, they shared the cost from the underlying investments. And it's a legal, legitimate practice to this day. It's more than fine. We are seeing some trends move away from that, but that's where that started from. And it just means that the advisor, the information they provide to you is, and the record-keeping services are other revenue sharing, but the 12B1 specifically are to pay that advisor for that information that they provide. And then suitability standards and disclosures are satisfied so that you may have the full transparency of what the fees are, what they're going to, and if they're suitable. So know that if you are in this particular arrangement, how much are those 12B1 fees in the plan, because they're based off of assets? And what services are you getting for those fees? And have you benchmarked those recently? Are you getting a reasonable fee for service? And that's really the key, what's reasonable. And that's what ERISA states, that what you pay is a reasonable fee. And there's really no way of knowing what's reasonable without a benchmark. And with a lot of these lawsuits going on because of that landmark ABB case many years back, the fees have been coming down. And so if you haven't benchmarked your plan in 3 to 5 years or so, you should have one as a best practice put in your fiduciary file to make sure that what you're paying and the services you're getting are fair and reasonable compared to other plans in the industry. The other distinct business model, advisor acts as in a fiduciary capacity. So they take on more responsibility. They don't take it a lot, because that's a common misconception out there among plan sponsors, is that if you hire a fiduciary, they take from you. And it's definitely not the case, but they can share in that responsibility with you. So many advisors currently are serving retirement plan marketplace already act in this capacity because those rules set forth by ERISA. You need that fiduciary standard. The advisor is providing investment advice directly to the plan sponsor, so it is advice. The advisor can be compensated through a flat fee or an asset-based fee that is level regardless of investment recommendations. So that's one way for you to know if the fee is the same, even if the asset base in your retirement plan has doubled or tripled over the past 10 years since we've been in a pretty steady bull market up until the first quarter of this year. If the bill hasn't changed, they're probably acting in this capacity. And then there are two types of level compensation fiduciaries. There is that 321 or a 338. So the 321 can make recommendations, but you as a plan sponsor would actually have to hit the button, so to speak, and implement that recommendation. Where if they act as a 338 fiduciary, they can actually make the move for you. So dictated by your investment policy statement, they put a fund on watch, maybe it underperforms a 5-year track record, and so they look for other managers to facilitate and replace that particular strategy. That fiduciary, that advisor can go ahead and replace it for you and take that workload off your shoulder. However, as Chris said, that doesn't take away that responsibility for you. You are working with that expert, and they are implementing that change. There's also service providers out there that's all they do. They act in a 338 fiduciary capacity as well. So, Chris, did you want to highlight anything more on that? It's these terms get thrown around a lot, 321, 338, and I'm sure a lot of people nod their heads without really asking more questions. But I think what a little time, yeah.
I think, what it really boils down to is two key concepts. One, plan sponsors and retirement committees are always going to retain that fiduciary responsibility for watching over their plan and taking care of their participants. And then it really comes down to who's picking the investments. So I think those are for the layperson, for somebody who's busy trying to figure out where they are with their fiduciary process or what model works best for them. I think those are the two key distinctions, or pardon me, the one key distinction to keep in mind. So I think for today, that's if we can leave people with that thought as they evaluate their situation, I think that would be successful.
That's great. And again, if you're a plan sponsor and you have any questions from who you're working with, please ask. If you don't understand something, you need to understand the advice given. So limited scope, 321, as I said, they give the recommendation, but ultimately you as the plan sponsor would have the authority to implement that decision. And then that discretionary 338 investment manager, in this role, the advisor has investment making authority to do it for you. So there could be a higher level of fee charged for that discretionary fiduciary as well, because they're taking on more of that responsibility. And in both cases, plan sponsors and the investment committees still have fiduciary responsibility for hiring and monitoring, if necessary, and the replacement of either the 321 or 338. So you always have that responsibility. If there is a poor decision being implemented, for example, by a 338, you still have that responsibility to oversee those decisions and those changes. 316, I mentioned that a little bit earlier. If you're working with a third-party administrator or a TPA, third-party administrator, they could act as a 316 fiduciary. And the duties of the plan administrator are set by ERISA in the terms of the plan document, and the responsibilities may be assigned to basically include maintain all necessary records, file Form 5500, provide documents and participants upon request, and then fix plan operational errors. So they would do this for you, act in that fiduciary, but you still have to monitor those TPAs as well. So how can I better identify potential conflicts of interest? So this would be a big responsibility for every plan sponsor out there. So we'll do a little bit of a case study. And I'll read this briefly, and we'll kind of pull out some of the lessons learned in this particular example. So retirement advisor acting in a fiduciary capacity may only recommend managers from his home office select list. These managers undergo a strict review, and underperforming managers are replaced on a watch list. If performance does not improve, advisors are required to recommend that the plan sponsors replace the manager. In order for managers to be considered for home office select list, they must be willing to pay the firm an annual marketing allowance. So you might think, well, that looks like a red flag. These to be included in this list, these managers actually have to pay. And so this is actually a common and acceptable practice out in the industry. And so to be included in this list of a broker-dealer, there is a fee involved. And however, they are best of breed managers. So if you do act in this capacity, or if you work with someone who acts in this capacity, feel free to ask that person if they do have a watch list, what it takes to get on that watch list. And are you comfortable with that marketing allowance? Personally, legally, it's fine. But this is one capacity where the retirement advisor, registered representative may act. Case study number 2, in competitive final scenario, an advisor recommends several funds that are offered by a proposed record keeper. These funds pay more revenue sharing than non-proprietary funds. And as a result, the total all-in fee proposed by plan sponsor is significantly lower than competing proposals. While some of these proprietary funds have an excellent track record, others haven't underperformed their peers and benchmarks in recent years. So if you think about a large record keeper who might also manage assets. Now, there was, in the ABB case, they had a provider that had lifestyle funds, basically their versions of a target date. And they got a deal. They cut them a lower cost by selecting proprietary funds, or proprietary funds is basically a fund that's managed by the record keeper. So XYZ record keeper, it would be XYZ large cap growth fund, for example. So that's okay to do if you follow your investment policy statement. In the ABB case, for example, they only looked at 3 funds, one of which was the replacing funds. So their motivation to replace about $250 million into the proprietary target date, the record keeper's managed fund, was really motivated by lower cost. Now, if the replacing fund met their investment policy statement and it had an excellent track record, then that's fine. I don't want to villainize proprietary funds. Just know your responsibility that you can select the record keeper's funds that they manage as long as they follow the investment policy statements. Don't be lulled into the appeal of being charged less and only selecting the proprietary funds based on that cutting cost of record keeping fees. Conflict of interest questions. So how does the advisor go about making specific record keeper, investment, and other recommendations to plan sponsors? It's a fair question. You know, how does the advisor go about doing that? Do they go through bidding process? Do they have multiple requests for proposals or requests for information? And is it backed by that data? What are advisors' conflicts of interest and how are they managed? So impartial advice is given to plan sponsors. If you're curious, if your particular advisor has any conflicts of interest, simply ask them what they might be. What is the process for documenting these conflicts and providing the plan sponsor with the necessary disclosures? Now, I'm sure you all get mountains and mountains of documents, and it's really hard to read all of those. Just like if you go on sign up for a new website and it says, did you read all the disclosures? You check the box. There's pages and pages. I think if you just simply ask them the question to see where in the disclosure documents where they might be, and you could read them for yourself, and they could highlight them walking through that paperwork. And what are the mechanisms in place to provide the necessary disclosure about conflicts of interest that may arise in the future? So what are the processes in place that they have to avoid it altogether? And if these are some questions that you'd like, maybe you can't write them down right now, like Lucilla said, I think she may even have emailed everybody these slides, so you should have these on record as well. So what are some additional questions? Oh, go ahead. Yeah, go ahead.
Sorry, no, this is really helpful real world stuff. If I might weigh in, This is also probably the most difficult task that plan sponsors, the retirement committees, are faced with. It's really sort of evaluating the fees that you pay on a net basis, not, where are there subsidies or revenue share or, things that come into play. It really, what it boils down to is tallying up all of the revenue, all of the cost associated with the plan, who is being paid what amount, and what are they, what services are they providing. So it really, on one side of the ledger, it's really the cost aspect, and you do get documents annually that are required to be sent to you. That's not that hard to sort of compile that big high stack of papers that Eric alluded to. The analysis is really around, what are we getting? Is it fully transparent? Do I understand it? And how does it advantage the plan participants? In some cases, paying a lower fee where there's some form of compensation involved does make sense, but that's sort of the trickiest aspect, in my view, that plan sponsors are faced with today, beyond keeping track of the investments. So I just wanted to weigh in with that thought there. Thank you.
It really is, and Chris made a good point. You talk about fees and the services, and if you take a look at any of these lawsuits out there, all they talk about is fees. The plan sponsor could have paid a lower fee, and they don't talk about the services provided as that side of the ledger. It's a fee for service arrangement, and if the person you work with do provide more services, then they should be able to charge more fees for those services, like in a fiduciary capacity, taking on that responsibility, educational meetings, literature they provide. So there's both sides of the ledger, and it is absolutely fair to pay for the services provided. And then you as a plan sponsor also need to understand, what are the services that are being provided? Are they appropriate for our plan? Are there maybe other services that would be beneficial as well? So first, you have to really get a handle on all the fees that are out there, and there are a lot of layers. It takes some question asking to understand what the net costs are, and then also take a look at, what are the services you're getting? Are they all valuable? Are there maybe some other things that you might benefit from as well? So what are some additional questions I should ask my advisor? And we're coming up. I want to be respectful of time, so we have about 8 minutes or so, and we'll zip through these. But I think these are the rubber meets the road for all of you on the call, to be armed with these questions to make sure you're getting the best advice and service that you deserve as a plan fiduciary. So what are the roles and responsibilities of each team member, which is very important to help you save time? Who you go to for questions on maybe the investment lineup, or is there somebody that can do education meetings at your firm? Who is the really key point there? Is there anybody on the team that takes notes on committee meetings? Basically so on and so forth. So what are all the roles and responsibilities of each team member, and know who they are? What is the experience of the team members, and what are their backgrounds? Is it more in education? Is it more in an investment analyst role? What is their experience, and what type of specific expert can you go to for different questions and have that knowledge? What are the designations and industry accolades earned by the advisor or the team that demonstrate commitment of excellence to retirement plan industry? So there's many out there. For instance, I went ahead and earned my AIF, which is accredited investment fiduciary, by learning about the processes that put in place. There's a lot of letters and acronyms out there. Go ahead and ask the people you work with. So what are these letters on your business card that follow your name? What does this mean? What did you need to do that, to get that? A CFP, Certified Financial Planner, AIF, CKP, it's alphabet soup. There's a lot of different things out there. And I'm sure they would love to tell you on what the accreditations that they earn and all that was involved into getting those. So ask. Plan philosophy. What is the advisor's philosophy regarding what a successful retirement plan might look like, and how will plan participants' success be measured? So in today's environment, there's a lot of different specialists out there. A lot of these plans have moved to people that act as a specialist, and within those specialist roles, they might even have a subclass that they focus on, 403Bs, for instance, or the 401k specifically, or even freezing pension plans. What is their philosophy regarding the participant success? Is it a dollar amount to reach? Is it, what's retirement ready? And that's very important with the rising cost of healthcare costs. Plan health by providing enough money. In the past, this was just an ancillary supplement to someone's retirement. Now it could be 100% of the money that they need to retire. If Social Security is reduced, there's no pension anymore. And is their replacement ratio, for instance, 80% replacement ratio of their income or 60% replacement ratio of their income to be ready to retire? And I mentioned healthcare costs, that if you provide a healthy plan, that provides your plan participants to be ready to retire on time and fulfill the next chapter in their life. And then once they do, once they move on, the healthcare costs overall in the plan would be reduced from that particular participant. But how do they identify success? How will employee education be executed? Will it be in person? Will it, after we all are out of quarantine, of course, will it be executed virtually like we're doing today? Are there modules in place that people can look at videos, pre-recorded or live videos on questions that they have, maybe on saving for an emergency fund or Social Security or income in retirement? How is that executed, and what type of topics are available? And then what is the advisor's history of obtaining successful outcomes? What's their portfolio look like? Do they have proof of delivering on what their philosophy is on success for both sponsors and participants for similar size plans and similar industries? So this industry has come so specialized, and that people have portfolios of particular companies that they've helped, and even down to that particular industry. So, an IT company is very different than a company that has a lot of employees in a warehouse. And how do you communicate with a mobile workforce? Maybe they're all truck drivers. How do you connect with people on the move that are mobile, maybe different locations as well that are not centrally located, especially right now? Are there maybe contingency plans? How do you educate via webinar like this one to people that might be scattered or working from home right now? And then what has their success rate been from their engagement? Plan pricing. So we talked a lot about fees and pricing. What does the advisor price and service based on percentages of assets or some other method, such as a flat fee or per head charge? So we talked about two different business models, whether they're paying out of the fund's assets or just a flat fee year over year. And then under what circumstances the advisor fee renegotiated? Is it ever negotiated? So how does that work? What is the advisor's philosophy regarding revenue sharing? And so, as I said, this is a legal and legitimate practice. Do they partake in revenue sharing where actually the fee goes up when plan assets go up, or is it a flat fee for service model? How does that work? So your key responsibility is really to understand the pricing model and the fees and services associated with that, and really how it works. Either one is fine, but you do need to know what's implemented and how it works. Some other things you can ask are track records of parties providing investment advice. Do they run portfolios, or have they picked the proper managers? What is their fiduciary screening criteria? What would they look like on a QDIA or qualified default investment alternative? Do they use target dates or custom models? How does that work? 90% of the money going into retirement plans are going into the qualified default investment alternative. Also ask them about money markets or stable value funds. Do they prefer one over the other? Both are fine, but both have pros and cons, where there were a lot of lawsuits against stable value funds in 2008, for instance, because there were gates or locks, and in times of financial crisis, a stable value fund could potentially be frozen, or you can't move out of it. However, now there's lawsuits against money markets because the yields are so low. So as a plan fiduciary, you need to understand the pros and cons of both. That guaranteed income of the stable value fund typically have a higher yield, but could potentially lack some liquidity. Money markets have very low yields, as you know, not even outpacing inflation, but 100% liquid. So both are fine, and understand the pros and cons of both. So the bottom line is plan sponsors should ask hard questions of their providers, and hopefully we've armed you with some of those questions that if you aren't fully understanding about some of the plans, just to recap, basically understand what the fees are, what the services you're receiving from those fees, and then how is it being charged? Was it through plan assets? Is it a flat dollar fee? So how does that work? And within this presentation, which you should all have, are some great questions to ask and understand so you can provide positive retirement outcomes for all of your plan participants. So we're coming up at the top of the hour. Here's some best practices, and then I'll hand it off over to Chris. But we're coming out of COVID-19 right now. It's been very challenging from a business perspective, and we understand that you dedicating the time for this webinar is very valuable. So having a committee meeting in Q1, we would very highly recommend you do so if you're taking into consideration the CARES Act, the withdrawal provision, which is an in-service distribution, or the loan provision of the CARES Act due to the COVID-19 virus. And document that if you're opting in or opting out. Are your investments in line with the parameters set forth by the investment policy statement? Are they meeting those risk return profiles? And make sure everything is in compliance and documented. So I know if you don't have a committee meeting on the books, you're very busy as business owners, but we would highly recommend that you do put something in place, whether it's virtually, that someone documents some notes on a couple of those topics. And then, Chris, would you have anything to add, especially right now? I'm sure you're working with a lot of plan sponsors. Any best practices you'd like to highlight as well for Q1?
For Q1, the consistency, I think, is key. Because you're memorializing your activities, your meeting minutes, and meeting notes, you really want to make sure you haven't missed a window. Now, certainly you can catch up if it was just not possible to schedule something, but you want to create sort of that paper trail that shows the consistency of your process and what your focus has been. Certainly the CARES Act is at the top of almost every plan sponsor's list for some consideration, whether or not they adopted it or not. So consistency is one. You've certainly earned your CPE credits today because there's a lot to think about. But from what I would recommend doing is when you get this presentation, take a look at it and make sure the questions that Eric has suggested you ask have been asked and answered, or are at the top of your list if you feel now that they're maybe worth focusing your time on. It's a process. You're not going to get through everything all at once, and fiduciary process implies that this is ongoing. So make sure that the questions you're answering, what you're trying to develop as a strategy for your plan, is consistent with how your committee is operating. And by asking important and relevant and very specific questions, you'll be able to hold your fiduciary partner, your retirement providers accountable to make sure that you're getting the services that you need for your employees. So I mean, you've covered a lot of great information, Eric. It does become sort of pretty heavy at a certain point, but I would consider this document, this presentation, to be a great way to go back to certain things that you maybe hadn't thought of in a while, and make sure you include them in your discussion with your committee and your providers, and then of course your consultant. So maybe just in the interest of time, pardon me, Eric mentioned, there's a good amount of specialization in the consulting field. Plan Pilot, I would consider to be very much a specialist. We are very focused on retirement plans, 403B plans as definitely an area of expertise, although we do some 401k plan as work. We are 100% conflict free, so we are only compensated directly by our clients, and we do the work for them and their committees. And our service model is what we would describe as being comprehensive. So we are not narrow in focusing just on the investment side. We're able to help out across all aspects of the plan. We only use senior consultants, people who have decades of experience in the field. And we feel we are very, very transparent, and we have very thorough and rigorous processes in place to help either make recommendations to our clients or help them make those same decisions. So we also have, as part of our extended team, legal counsel who's able to help us weed through some of the trickier or more technical issues. So for any questions you may want to have above and beyond the follow-up for CPE and the presentation, you can feel free to contact me at Plan Pilot. My contact information is on the next slide. You'll see it there in a moment if you could advance the slide, Eric. So I'm at chris.garrison at planpilot.com. You can see my phone number there, and of course Eric's information is directly below mine there. So we welcome any and all questions that you have to follow up today's session.
All right, thank you, Chris. And as Chris said, yes, if you have any questions for me directly or Chris, please email us. We'll be happy to get those to you. I don't see any questions in the question field, so I'll hand it back to you, Chris. And thanks everybody for joining us today.
Great. I have nothing more to say than thanks again for your time. I consider us to be a resource to you now and in the future, and we look forward to hearing from you. Thank you very much.